Hi, everybody. Welcome. As Sophia said, we're going to get started in just a minute or two. One thing to share with you all, some conventions on the use of the chat, since you are all on mute, but we still really want to engage with you and hear your thoughts, what resonates with you or whatnot. Please, we ask you to use the chat box. And some quick conventions that you might be familiar with is that if you hear anybody either in the chat box say something or us that when we're presenting and you agree with it, feel free to add a +1. And also, if you're referring to any comment that anybody else said on the chat box, please make sure to use the @ and their name. And so in that way, we can track when you're building on something that somebody else said. So please do use the chat box. We're going to be keeping an eye on it to make sure that we engage with you that way. Thank you. And I'm going to go ahead and introduce myself on the chat box too. So hopefully with that, we'll kick it off for others to do the same.
The other thing I'll mention is that throughout the session, we absolutely encourage you to send any and all questions, and you can do that by clicking on the chat button at the bottom of your screen and finding Sarah Zukovsky, who is labeled as the questions and tech lead, and she'll be aggregating all of your questions, and we'll make sure to get to as many as we can in the second half of today's session. So feel free to send her any questions that are on your mind, starting now and throughout the session, and we'll try our best to get to all of those. All right, well, welcome everyone, and thank you again so much for joining. And as a few additional folks are trickling in, I'll go ahead and get started with just a couple of housekeeping items. First off, this is an open session. It's on the record, and there may be some journalists in the room, just so that everyone is aware. A quick reminder as well that people can move in and out of breakout room sessions, and that's definitely encouraged. The purpose of this convening is to make sure that you get as much relevant and practical information as you can. For those that are just joining, welcome. We'll be focused in today's session on an introduction to impact investing. Feel free to introduce yourself in the chat and where you're from. And I'd also like to introduce Sarah Zukovsky, who is our tech lead and will also be fielding questions. And so for any questions that you have throughout the session today, please send them directly to Sarah in the chat function. She's labeled as questions and tech lead. She should be the first person on your list. And please feel free to send messages directly to her with any and all questions. And at this point, I believe we'll begin recording the session. So once again, thank you all so much for joining us and for taking the time to be here at the Next Normal Now. I'd like to think that at a fundamental level, we're all here because we have a set of shared beliefs. In fact, most of us are likely in agreement about most of these things. We know that global inequality is growing. We're all experiencing and seeing the urgencies that are manifesting around us and the massive inequities when it comes to race, to gender, to basic human rights. None of this is new, but this pandemic has certainly brought these inequities, among others, to the forefront. We probably also recognize that climate change is a crisis, and the consequences of not acting are frankly catastrophic. And we also realize that capital is powerful, yet our existing financial systems are not working and are very capable of doing more. Whether you're an institutional asset owner or a fund manager or a social enterprise or an activist or a student, there's a role for each of us to play in building a better, a more resilient future starting now. And so for that reason, we're so grateful that you're here with us today. My name is Sophia Sunderji, and I sit on the research team at the Global Impact Investing Network, or the GIIN. And I get to work on uncovering data insights about impact investing, conducting research, and then sharing those findings to inform stakeholders in the industry and those looking to join. I have the absolute pleasure of being joined by my colleague and our head of impact standards at the GIIN, Leticia Emme, who will lead our question and answer session today. And I'll turn to her now to introduce herself.
Thank you, Sophia, and thank you everybody for joining us today. I'm thrilled to be here. Sophia, she just mentioned, I'm the head of impact standards and engagement at the GIIN, and I work on our impact measurement management practice, leading the development of IRIS+. We're going to touch a little bit on this today during the session, and I'm also going to be helping moderate some of the questions that come through the presentation. So please, any questions that you have as we go through, as Sophia just said, she gave you the instructions, and then we'll open up later to exchange and discuss with all of you. Back to you, Sophia.
Wonderful, thanks, Leticia. So the Global Impact Investing Network, or the GIIN, is a global champion of impact investing and has a decade plus of experience in building this industry and really in growing the scale and effectiveness of impact investing. We do this in a couple of different ways. Firstly, through engaging with investors, from large insurance companies and pension funds, all the way to smaller, more niche fund managers. Secondly, through guidance on impact measurement and management practices, including the creation and management of IRIS+, that's IRIS, and then a plus sign, as Leticia mentioned, which is the generally accepted system to measure, manage, and optimize impact. And then finally, through market research to inform activities and to inform investor practice. Ultimately, our vision is of a world where financial markets serve all members of society, and where finance really plays a central role in solving the social and environmental challenges that we see today. And really what we envision is a world in which investors integrate impact considerations into all decisions simply by default, really as the normal way of doing business. So given that, our focus of today's session, as most of you probably know, is really to better understand the impact investing industry. We'll start off with some background on what impact investing is and also what it's not. We'll share some key trends on market activity in the impact investing industry and a couple of key findings on financial and impact performance. And finally, we'll share just a couple of reflections on what's next on the horizon for this very quickly growing industry. Our goal is to be sure that this session is really whatever you want it to be. So after sharing a couple of these insights, we'll turn to you and open it up to questions and answers. So as I mentioned before, certainly continue to share your questions with Sarah Zukovsky. She is labeled as the questions and tech lead in your chat box in the bottom of your screen. And we look forward to getting started. So to kick us off, the universe of investing with impact is big. It's expansive and it often feels complex. And so we'd like to start off by distilling what we really mean when we use the term impact investing. Impact investments are investments made with the intention to generate positive, measurable, social and environmental impact alongside a financial return. This means that impact investments can really run the spectrum and ultimately reflect an investor's objectives. They can be made into both emerging and developed markets, across asset classes, whether it's private debt, private equity, real assets, public markets, and they target a wide range of financial returns, from market rate returns all the way to below market returns. I'll also emphasize that impact investing is not philanthropy. Of course, there's an incredibly valuable role for philanthropy along with traditional development aid. And impact investing really works alongside those tools, focusing on using investment capital to achieve more than just financial returns. But this doesn't mean that you can't have both. And what we know, based on the evidence, is that impact investments can generate both financial and impact returns. The other piece I'll mention is that impact investing isn't inherently risky. And similar to non-impact investments, we see tremendous opportunity for all kinds of risk profiles. And then finally, and this is really the big one, impact investing is a strategy. It can be applied really to any kind of investment. And what this comes down to is a deliberate choice to generate impact and use impact data in making decisions, which is just incredibly powerful in all sorts of ways. We see significant dispersion globally in impact investments, with just under a third of investments made into North America, about 15% made into Europe, 12% into Latin America. And I'll mention that this is based on the GIIN's most recent impact investor survey, looking at a sample of impact investors in the industry. And then we also see, of course, significant diversity in the players themselves that are making impact investments. Asset owners and asset managers, from pension funds and insurance companies to fund managers and nonprofits. But the reality is that that's just one part of the ecosystem, and other types of organizations play an equally critical role. We see companies and businesses with a social or environmental aim, social enterprises, for example, who are the investees on the ground creating the impact, the organizations that investors are capitalizing. Then there are activists and advocates who continue this cutting edge work and continue to push the boundaries for the values that we all believe in. Researchers and academics that are uncovering important patterns and data on trends in the industry. Yet despite this diversity, there are 4 core characteristics that make investors impact investors. The first is intentionality, a genuine interest and motivation to generate some kind of environmental or social impact. Secondly, impact investors set those intentions with evidence and impact data. And so alongside an investment thesis, an impact investor will also have an impact thesis. And the impact associated with an investment needs to be actively measured, really to get at the core question of how do you know that you've generated some kind of social or environmental impact? Third is managing that impact performance. And so that would mean tracking progress using impact metrics, reporting on performance, and perhaps most importantly, integrating those impact learnings into the investment process to manage performance more effectively with the goal of increasing your overall impact. Really the same way that you would for your financial performance. And finally, the fourth is building the field. And so really a big part of that is sharing learnings, informing other actors, building research, and growing the marketplace. This industry is growing and has tremendous potential to really revolutionize the way that we think about capital markets. That's made quite clear by the GIIN's latest market sizing study, which found that the impact investing market is valued at $715 billion across 1,700 organizations, which is nearly $1 trillion. And this is just the beginning. There's a significant supply of capital that has the capacity to address some of the world's most pressing challenges, and that supply is only growing. And so let's take a look at what that means in practice. We know that the industry is growing in both depth and sophistication. And so I'll go ahead and share just a couple of high-level data points to help us unpack some of these trends and activities in the industry today. Impact investments are deployed across a range of asset classes, most commonly through private debt. And what we see actually is that though the asset classes used most commonly by investors are private debt, private equity, and real assets, we see significant assets under management actually allocated through public equity, which really demonstrates the strong potential in both public and private markets. We also see huge diversity in organization types. Asset managers are the most common organizations making impact investments, accounting for about 65% of total investments in this sample. But we also see foundations, development finance institutions, family offices, larger banks, and then increasingly, we're seeing strong appetite among institutional asset owners. So think pension funds and insurance companies. And some of the GIIN's latest work is really focused on mobilizing capital and working with these players that are keen to invest with impact and apply strategies to do so. We also see that impact investors are pursuing a wide range of impact themes across sectors, with the majority of assets under management dedicated to investing in access to basic services like energy, financial services, housing, and healthcare. Just over 2/3 of impact investors target market rate returns. And this really brings us back to the premise of impact investing, allocating capital in a way that generates both impact and financial returns. Of course, there are impact investors that choose not to prioritize financial returns. And this is often by organizations with an impact first mandate, a foundation, for example, or a nonprofit fund manager. And in fact, that's exactly what we see in the data. Impact investors are often driven by both financial and impact motivations. And so on the impact side, as you can see here, impact investing is really central to their mission and part of their commitment as a responsible investor. And then on the financial side, investors are responding to client demand. This is what clients, pensioners, beneficiaries ultimately want. And impact investments are seen as financially attractive relative to other investment opportunities. And so this brings me to the final piece that I'd like to share today. This is all good and well, but what about the performance of impact investments? And you know, we get questions all the time about performance. The reality is that impact investors report overwhelming satisfaction in relation to their financial and their impact performance expectations. 88% of impact investors are either meeting or exceeding their financial performance expectations, which is a pretty staggering statistic. And so I'll say that one again, 88% meeting or exceeding financial performance targets. And nearly every single impact investor included in our research sample feels the same about their impact performance. We see that impact investors are often balancing different levers: financial return, impact objectives, risk, and others, and ultimately making decisions that enable them to meet their objectives and achieve strong performance. And as many of you will know, that's much like what we see in traditional or non-impact markets. The data tells us that market rate returns can be achieved across asset classes, contingent, of course, on investment strategy and asset manager selection. And so in this chart here, we can see the significant distribution of realized returns for investors seeking market rate returns, with the top 10th percentile and the bottom 90th percentile reflected, along with the average realized financial returns since inception across asset class and market type. As you can see here, unsurprisingly perhaps, private equity investments generated higher returns on average than investments through debt or real assets at 18% and 16% on average. And this really mirrors what we see in those non-impact markets. But financial performance is only part of the equation. Impact performance is equally critical in understanding the holistic performance of any investment and ultimately to assess whether we really are moving the needle on some of those significant social and environmental challenges. To understand that, impact investors measure and manage their impact. Most commonly, they'll do that using the United Nations Sustainable Development Goals, or the SDGs, which offer a set of overarching impact goals, followed by IRIS and IRIS Plus, which is the generally accepted system to measure, manage, and optimize impact. I'll mention that the GIIN manages IRIS Plus, which is a system that helps investors to translate impact goals into real results. IRIS Plus was created in collaboration with over 1,600 stakeholders and is managed right now by the GIIN. And key features of IRIS Plus include core metric sets, which help investors measure progress towards impact goals, and an evidence base, which helps inform an investment's theory of change. And this really makes it streamlined for an impact investor or other organizations to measure and manage their impact. I'll also note that the system is used by over 10,000 organizations globally across both developed and emerging markets. And it's used by some of the largest investors in the industry, from asset managers and pension funds to development finance institutions, and also across a range of other organization types too. And really what this speaks to is the growing standardization in the industry when it comes to measuring and managing impact. What's especially exciting is just the incredible impact insights that can be derived from using these standardized metrics and then applying a standardized analytic process. At the GIIN, we've most recently been focused on building out impact performance studies and a methodology to understand how do you compare investments on the basis of impact. And this really paves the way for industry impact benchmarks, ratings, and all sorts of other tools, which is ultimately key to using capital more efficiently, more effectively, and ultimately achieving more impact. That's really what we need to advance practice in the field. Transparency in impact data is absolutely critical, along with integration of impact data into decision-making. And that's why the GIIN is focused on its mission to integrate impact into every decision and to equip investors with the tools to do exactly that. We each have a role to play in this. The challenges that the world is facing are far too urgent for impact capital to underperform. We know investors increasingly want to align their values and the values of their shareholders, their clients, their pensioners with their capital. This industry is only growing, and there are huge, huge sums of capital sitting on the sidelines just waiting to be unlocked. And we can each play a role in achieving that vision. So we're very grateful that you're all here with us today. And at this point, I'm delighted to turn it over to my colleague, Leticia, who will open up the floor to questions. As a reminder, certainly feel free to continue sending your questions to Sarah, who is labeled as the questions and tech lead in your chat function. And with that, Leticia, over to you.
Great. Thank you, Sophia. Thank you to the ones who have already been sending your questions. Please feel free to continue to do so. We have a good amount of time dedicated to discussion, really to, as Sophia was saying, to make this session what you wanted to make, answer your questions, share any reflections. So I'm going to get started by reading some of the questions that we received. One of them says, are there any industry-specific frameworks, for example, for energy, education, or health, that can help build impact theses for new areas of investments for new or existing impact investors? So on these, I'm happy to tell you that IRIS Plus, which is Sophia just provided an overview, is a system managed by the GIIN. This is also a public good. Let me make that clear. That the GIIN manages and provides for free to the industry. So IRIS Plus is a system, and as a system has several different components of key features. So Sophia mentioned some of them. It has core metric sets, which are a short list of metrics. It has the IRIS catalog of metrics, which we've managed for over 10 years, which is a long set of comprehensive catalog. Sophia also mentioned it has a built-in evidence base. So the built-in evidence base, what provides you is access to academic and field research that can help you inform a theory of change. All the resources in IRIS Plus are organized on a thematic basis. So if I invite you to, after this session, to go into IRIS Plus, create an account. Like we said, it's free and it only takes a few minutes. And once you create an account, also anything that you do in the system, when you come back, it will be saved there. But you will go in and you can, create different, frameworks or profiles on a thematic approach. So you could say, for example, I'm interested in investments in education or in health or in housing. And then for each of those, the system will give you a built-in evidence base. And so what I'm saying with this is that you will already have access to evidence that you can use to inform your theory of change, for example. So feel free to go and check it out. And if you have any questions, we do ongoing demos, or you can email us and we are happy to help you navigate. next question. So the next question is, how is impact assessment different from risk assessment in a traditional investment setup? So that's a good question. And impact, you might have heard, and Sophia, please jump in and let's both answer this one together. But you might have heard, people talking about impact being multidimensional. When we talk about impact, we usually refer to several different dimensions of impact. And if anybody's familiar with the 5 dimensions of impact that the Impact Management Project developed, I think these are really helpful to help think about impact in a contextualized way. So usually you want to start by thinking at what are you trying to do? What is your objective? Who is receiving, who's going to be affected by this intervention or investment? How much change are you achieving? What looks both at scale and depth. Contribution, which looks at how are things different that would have otherwise been, and risk. So impact looks in a very comprehensive way at several aspects, which is different than just thinking about risk assessment on a financial only way. So risk is one of the dimensions of impact, but it's also different than just pure financial risk. And impact risk, we would look at also what are both positive and negative risks related to the impact. So what are things that maybe would prevent you from achieving the impact that you wanted? So let's say you have the intention to improve financial health of population. So what are things that in an investment can go wrong and that outcome not be achieved? So that would be more on the impact risk, which is different than just pure financial risk. And the last thing I would say is that what we believe in is that we need to integrate both financial and impact considerations to make decisions. So you will still have your risk assessment, but you will integrate together your impact assessment as well.
I'm happy to jump in here, Leticia, and maybe the only other thing I'll add is that we have a few in practice examples of some of the risk considerations, in particular on the impact side, that impact investors are considering. And you can find this actually on our website as part of our impact performance studies, where we collected impact data from impact investors across a set of sectors and impact themes, including clean energy, housing, financial inclusion, agriculture. And there's a section in each of these reports that does delve into a fair amount of detail on impact risk specifically. And 2 of the most common risks that we see investors are facing sort of across the board are external risk and execution risk. To Leticia's point, these are featured in the Impact Management Project, but certainly feel free to check that out as a resource if that's interesting for you.
Wonderful. Next question, Sophia, I would love for you to take this one. It says, can you please help me understand the vehicles through which impact investments are manifested, other than the most obvious private debt and private equity? So I think we had one of the slides actually looked at several different instruments or vehicles and data that came from the annual survey. But Sophia, could you please jump in?
Yeah, absolutely happy to. And this is a really critical question because we do see that the industry is evolving tremendously. And in reality, right now, the 3 most common asset classes that are used are, to your point, private equity, private debt, and also real assets, which plays a pretty fundamental role. We are seeing increasing allocations towards public debt and public equity. And what's interesting to think about is what impact strategies look like in the context of those public markets. And so recently, the GIIN has been doing some research on listed equities, and we'll continue to explore that as we better understand different impact strategies in the context of public markets. But according to our survey data, while the most common asset classes are private debt, private equity, and real assets, in reality, there is just such substantial assets under management being allocated through public equity in particular, which speaks to us really the larger than average deal size when it comes to public equity. And so certainly something to keep an eye on as the industry continues to evolve.
Wonderful. Sophia, next question for you. How are returns realized? What is the average time horizon, and is exit strategy different in impact investing?
These are fantastic questions, and the GIIN has actually spent quite a bit of time unpacking this question around financial performance, realized returns, sort of the horizon, and also exit strategies. And so perhaps what I can share is just a little bit of our findings, and then we'll certainly point you to our research where you can find a whole bunch of data points and additional insights. But broadly, what we hear is that there are concerns around financial returns. The reality is that investors are always making choices and constantly trying to achieve their own objectives and to determine how to achieve the best possible financial return for the least amount of risk. So when it comes to impact investors, we add in that additional factor of impact. And ultimately what we see is that impact investors are looking to deploy the minimum amount of capital to achieve that best combination of financial and impact return. So for each dollar invested, what is the best financial and impact return that can be generated? So at the end of the day, it really does come down to decision making and balancing the various levers across financial return, risk, liquidity constraints, resource capacity, and in the case of impact investors, those impact considerations. So I'd certainly recommend that folks take a look at our recently published report on financial performance, which explores that idea of a dynamic decision-making model and unpacks the considerations. But it also synthesizes existing industry research that looks specifically at the financial returns across asset classes in private markets. The overarching key finding is that impact investors can generate market rate returns, but that those returns vary widely. In some cases, we see outperformance relative to traditional financial benchmarks. At other times, we don't. So for example, I think the top 10% of private equity portfolios in emerging markets generated realized returns greater than 29%, whereas the bottom 10% generated returns below 6%. This is based on the GIIN's Impact Investor Survey, and we certainly invite you to take a look at this research and others on our website for more data points. And the other thing I'll point to very briefly is just the idea of responsible exits, which is a really critical component of any impact investment. And so we'll also certainly invite you to take a look at that research, which is available on our website, and essentially details what impact investors are considering when it comes to making responsible exits.
Thank you, Sophia. We've had a couple of questions asking about tools, and one of them actually was asking if we could show the slide. Are we able to go back to the annual survey slide with the different tools and percentages?
Absolutely.
Okay, great. So yeah, somebody was asking to look back at that tool, and then somebody else was also asking if we can help them navigate some of the tools. And so this is somewhere we're happy to help navigate through this. We know that, the first time you look at this, it might look like a lot, and which tools I could use for what. And so we are happy to help you understand a little bit the different uses of this. And also say that at the GIIN, we work very closely with pretty much every single organization and initiative that you see here. And there has been a lot of harmonization in the market. So don't worry, these are not all overlapping or duplicative by any means. One of the things that we found out with the annual survey, which was really interesting, was that, as Sophia said, the United Nations Sustainable Development Goals are, the #1 framework or tool that investors tend to use, followed by RS+. But when we then ask them, how do you use them? Because they're actually quite different. What we found out is that the SDGs are usually used to frame the goals or to set your goals and frame your goals. Whereas Iris Plus is then help to, to the how. They know, okay, how do I measure progress towards my goals? The impact management project, as we mentioned before, I know we're providing a lot of information really quickly, so happy to go back to anything that you guys want. So the impact management project helps set a convention, if you will, that talks about, how do we talk about impact in a common way? And so that's the 5 dimensions that we talked about. The UN PRI, which are, the principles for responsible investment, are, very well known as well. B analytics, GIIR's ratings, I think are not longer conducting them, but this is B Corps or B analytics or the B impact assessments. We're very close with them, and IRIS and B Lab actually have a very close alignment. But B Lab targets mostly companies or enterprises, whereas, for example, at IRIS Plus, our main audience tends to be investors. The operating principles for impact management, they were chaired by IFC, but really are not just IFC, but really for the industry. Many investors are signatories of these operating principles, and these are, just as the word says, they're principles about how to, you should go about your impact management. So it's, as you can see here, the tools are all in different levels also, which help you with different things. GRI, you might be familiar with this. Those are more standards on disclosures for companies. ARIS is a CTFI, so it's for community development financial institutions, a rating system. SASB, similar lines to GRI, but with a materiality focus. So there's a lot of tools out there, and we're happy to answer any other questions with these, but really they all really serve different needs in the market.
Maybe the one other thing, Leticia, I might throw out there is just when thinking back to the very first annual impact investor survey that the GIIN conducted. So this is back in 2010. The findings indicated that about 85% of respondents to that survey used their own proprietary framework to measure impact. And now, 10 years later, from this 2020 survey, we see that about 89% of respondents are using an external resource to measure their impact. So I think it very much speaks to your point, Leticia, that there has been just significant evolution that goes a long way to addressing some of those concerns around fragmentation when it comes to tools and resources that are so different. In fact, a few years ago, I think one of the biggest challenges in the industry was fragmentation and just the various different tools and frameworks and systems to measure and manage impact. And most recently, the data showed us that while that's still a challenge, that fragmentation is also an area of greatest progress. And so I think that there has been just tremendous coalescence around a small handful of tools and systems that investors are using together in a complementary way. And what we see is that the average impact investor uses about 3 of these tools or frameworks, which serve different purposes.
Excellent. Thank you, Sophia. So somebody's asking also, what tools can be helpful for small nonprofits? And, like we said, there's different tools that can be used for different purposes. And for example, the SDGs, I wouldn't refer to them as a tool, it's more as a framework, but they're out there for anybody to use. And then IRIS Plus, and I'm not saying this just because I work there, but really, it is a public good. So that is really helpful for small nonprofits, not having to, buy or pay anything necessarily, and then just use it on the thematic approach and find the resources that you need. So that's something that I would definitely recommend for smaller nonprofits. And even though we mentioned a lot of investors, they are our core audience, but they are not the only ones that use IRIS Plus. When Sophia showed the use of IRIS Plus all around the world, it really is used by all actors within the impact ecosystem, enterprises, academics, regulators, standard setters, consultants, and whatnot. Next question, and Sophia, I think we have some data on this also from the latest survey, but can you talk a bit more about the movement or trend towards third-party impact verification?
Yeah, absolutely. So this is certainly something that we're hearing more and more about. And so in the GIIN's most recent survey on the state of impact measurement and management practice, one of the sort of topic areas that we explored was third-party impact verification. And what we found is that I think around 46% of impact investors that we surveyed have some kind of third-party external impact verification, which is heartening to see, but also speaks to the fact that we still have a long way to go. And I think there is perhaps a gap in the industry when it comes to infrastructure that is continuing to be filled. And so certainly lots of opportunity there. But I know that Tideline has recently come out with Blue Mark, which is a tool to help organizations verify their impact, which is sort of an important step forward in that. But I will certainly say that what we see in a lot of the data is that impact verification is a challenge in the industry right now.
Excellent. Another question. So I realize we have been referring quite a bit to the annual survey or different surveys that the GIIN has done over the years. And one of the questions is saying, who are the groups you surveyed for these percentages and what is the survey size? So Sophia, can you please shed light on that?
Great question. So for this particular survey, we had about 294 respondents in total that completed the survey and submitted data. And so a lot of these stats and data points that we're referring to do come from that sample of impact investors. And within that, the sample includes a range of organization types. Primarily asset managers, which account for about 65% of the total sample. And half of that is for-profit asset managers and the rest not-for-profit. But then we also see foundations constitute about 14% of the sample, followed by development finance institutions, family offices, diversified financial institutions, and a handful of others. And so it really is quite a big range in types of players and organizations, which certainly speaks to the diversity that we see in the industry.
Excellent, thank you. There's a number of questions that have come from different people asking more about the role that smaller stakeholders could take into impact investing, whether it is, where startups or what, how can small investors participate on this beyond just looking at ESG and donating to nonprofits? What role do you see small grassroots level nonprofits playing in the larger impact investing strategy? How do small investors participate on this? So I think one thing that we'd like to clarify, and Sophia would love to join me on this too, that you don't have to have a specific size of your assets under management to be in impact investing whatsoever. We went through in the beginning through the core characteristics and really what makes an impact investor or what defines an impact investors are these characteristics of having the intention to generate positive social and environmental impact, using that impact data for the design of your investments and decision making, managing your impact performance, and helping to build the field. So there's different ways you can engage. I mean, if you're an investor, you can start talking to your investees, seeing what kind of data they have about their impact, and if they don't have any, maybe start suggesting that they start considering capturing some of this data. We believe that every investment has an impact, so whether you are aware of it or not, it does have it. And the same for an enterprise. Every enterprise has an impact on the people on the planet and those that they're working with. So, you can start small and start understanding what are the different pieces of data that will help you better understand, your impact and communicate that, and then managing that. That's the very important piece. We would never, ask the field to be just measuring or, gathering data just for the sake of gathering data. The whole idea of this is to using this data to inform your decision making. Sophia, anything that you would add to that?
I think that's exactly it, Leticia. And I'll mention that one of the big efforts that the GIIN has been focused on recently is the methodology for standardizing and comparing impact performance. And here what's really critical is thinking about how efficient you are with each dollar invested or with the capital itself. And what we're hearing a lot about in the industry, especially recently over the past couple of years, is mobilizing capital. And I referenced it myself, all of that capital that is sitting on the sidelines just waiting to be unlocked. And that's true and that's important. But what is equally important is within the capital that is already being allocated towards impact, how to make sure that we're using that capital in the most effective and the most efficient way. And that really does come down to Leticia's point around managing investments with that impact in mind and integrating impact into all of your investment decisions across the investment process. And so whether it's setting strategy up front and thinking about different ways to design a portfolio or to design an investment with impact considerations in mind, whether it's conducting due diligence and selecting an investment with higher impact potential, whether it's managing that investment and considering the different levers that you can pull in order to increase your impact potential. Maybe it's offering technical assistance, maybe it's the way in which you engage with stakeholders, and then also the exit considerations when you conclude the investment and thinking about how to ensure that the impact resulting is long lasting and really in duration or is durable. And so I think that those are some of the really critical components that we're thinking about, and that certainly applies to big investors just as much as it does to small ones.
Wonderful. We have a couple other questions on the role of DFIs. So DFIs are diversified financial institutions, such as, for example, IFC, we mentioned with the operating principles. So we have two questions that say, what role do DFIs such as IFC play in the field? And then somebody else said, I'm quite interested in learning how diversified financial institutions are approaching or utilizing impact investing. So DFIs have had a long history, I would say, with impact investing. Maybe, some of them, even before, the term impact investing was coined, and maybe they were looked more as, development work that they were doing. But the DFIs are a strong community. They've done a lot of work over the years. We work very closely with them. There's a group of DFIs called HIPSO, or not a, sorry, let me clarify that. There's a group of DFIs that have come together to harmonize what they measure. And that initiative is called HIPSO, which is the Harmonized Indicators for Private Sector Operations. And we actually work really closely with them, aligning our risk to their measurement. And we recently launched the Joint Impact Indicators. So we work really closely with them. There's a wealth of knowledge that DFIs have just because they have been investing for decades and decades. And what I think is wonderful about DFIs is also they are very welcome generally to share a lot of what they have learned. So very much the fourth core characteristic about helping build the field. So if there's any other more specific questions about DFIs, I'm happy to answer them. But just to shed a little bit of light on the role that they play, I think many of them do play a leadership role in terms of sharing their practice and helping advance the field. And one of those examples has been, for example, IFC, with the who helped chair the development of the operating principles for impact management. Another question, more in the world of resources, says, what are platforms, guides, and newsletters one can make use of to better be informed, particularly on private debt, on the private debt space? So here, we're not endorsing anything, but just, maybe we can share. Sophia, I would love for you to share, some of the, resources we find helpful. I would, of course, say, the GIIN newsletter and the IRIS newsletter are good. I think Impact Alpha I find pretty interesting. There's PitchBook also has one. What are some on your radar, Sophia?
I think the others that come to mind are Symbiotics, which offers some great information in the form of newsletters and also just research publications, in particular on private debt. And then the other one that comes to mind is Cambridge Associates, which many folks may have heard of. And the focus there is probably more on private equity, but still some valuable insights on impact investing in terms of the benchmarks that they've put out.
Excellent. We have about 3 more minutes, so we're going to tackle a few more questions. We have a lot coming, which is wonderful. If we don't get to answer your question, apologies. You can follow up with us via email, and we're happy to continue to connect on a one-on-one. But for the next 3 minutes, Sophia, and we can tackle this one together. What do you see as some of the most important opportunities for the sector going forward?
That's a great question and a challenging one, but I think it very much stems from some of the gaps that we see in the industry right now. And what we see in the data is that impact investors will say again and again that they're struggling or that they're unable to compare their own impact performance with others in the market or others in the industry. And what's interesting is that we also hear them say that in terms of the resources that would be most useful, impact benchmarks is the one thing that folks will turn to again and again as being an incredibly useful and critical tool to enable those types of comparisons. And so in my mind right now, the biggest challenge is sort of figuring out how do we fill that gap and provide impact investors with the tools and resources that they need to use impact in their everyday decision making. And I think impact benchmarks and ratings and other tools and indices can play just an incredibly powerful role in helping investors to do that.
Wonderful. Thank you, Sophia. Do we have a few seconds for our last one, or are we at time?
Maybe a very quick one, and then I'll wrap up.
Super quick one. Okay. So there was one other one on if we can further unpack how policy and regulation inform impact investing, and to what extent are policy experts engaged in the framing of the objectives and assessment of impact. So super quick here, just to say that over the last decades, governments have played quite an important role in facilitating the development of ecosystems that have unlocked the potential of impact investing in their own countries. And we see actually quite a lot also happening in Europe in terms of regulation and the EU taxonomy, but definitely we think that regulatory environments, when they're supportive, they can help grow the market. Okay, so on that, Sophia, back to you.
Wonderful. It's unfortunate that we're nearing time because I know there are just so many fantastic questions that came through, but I think I'll just say thank you so much to each and every one of you for joining us and for really recognizing the need to drive systemic change and inclusive economic growth, and for your critical and really thoughtful questions about the impact investing industry. Our next session for this convening is the fireside chat with Amit Puri and Carol Ann Hilton. So we invite you to please go ahead and rejoin the main webinar. To do so, you'll just need to use your unique access link that was provided in your registration email. So go ahead and join, and we'll see you back in the main session. Thank you all so much again for joining us. And of course, feel free to reach out offline with any other thoughts, questions, or comments. Thank you.